Welcome to a lecture on bonds, where we dive into bond pricing fundamentals. We'll cover par value, coupon rates, and the critical inverse relationship between bond prices and yields. These concepts come up frequently on the test, so let's make sure you understand them cold. Let's start with the core terminology you need to know. Par value, also called face value, is the amount a bondholder receives when the bond matures. For most corporate and government bonds, that's $1,000. Think of it as the bond's sticker price at maturity. The coupon rate is the annual interest rate stated on the bond. This rate is locked in when the bond is issued and never changes. If you have a bond with a 5% coupon and a $1,000 par value, you're getting $50 per year in interest. The maturity date is simply when the issuer pays back the principal, and the coupon payment is the actual dollar amount of interest you receive. Now let's talk about how bonds are priced in the market. When a bond trades at par, it's selling for exactly its face value, $1,000. When it trades at a premium, the price is above par. When it trades at a discount, the price is below par. Here's something important. Bond prices are quoted as a percentage of par, not in dollars. So if you see a bond quoted at 98, that means 98% of 1,000, which equals $980. A quote of 105 means $1,050. Why would anyone pay more than face value for a bond? It comes down to interest rates. When a bond's coupon rate is higher than current market rates, that bond becomes more valuable. Investors will pay a premium to lock in that higher income stream. Picture this. You own a bond paying 6%, but new bonds hitting the market only pay 4%. Your bond is suddenly more attractive. Buyers will pay extra, above par, to get those higher payments. The opposite happens when coupon rates fall below market rates. If your bond pays 3%, but new bonds pay 5%, your bond is less attractive. To sell it, you'd have to offer a discount. That lower price compensates buyers for accepting below-market interest. Remember, discount bonds have coupon rates below current market rates. Premium bonds have coupon rates above market rates. This brings us to one of the most fundamental concepts in fixed income: the inverse relationship between interest rates and bond prices. When interest rates go up, bond prices go down. When interest rates go down, bond prices go up. Always. No exceptions for fixed-rate bonds. Why? Existing bonds must compete with new issues. If new bonds offer higher rates, existing bonds with lower coupons must drop in price to attract buyers. This inverse relationship is heavily tested, so make sure it's second nature. Think of it like a seesaw on a playground. Interest rates sit on one side, bond prices on the other. When rates rise, that side of the seesaw goes up and bond prices tilt down. When rates fall, prices rise. This applies to all fixed-rate bonds: treasuries, corporates, municipals. The seesaw never lies. Here's where students sometimes get confused. The coupon rate is set at issuance and never changes. A 5% bond will always pay 5% of par, $50 per year, regardless of what happens to market rates. What does change is the bond's price and its yield. Don't confuse the coupon rate, which is fixed, with yield, which fluctuates as the price moves. Let's work through a quick example. You see a bond quoted at 102.50. To find the dollar price, multiply 102.50% times $1,000. That gives you $1,025. Since the price is above par, this bond is trading at a premium. That tells you the coupon rate must be higher than current market rates. Otherwise, why would anyone pay extra? Let's recap the essentials. Par value is typically $1,000. The coupon rate is the fixed annual interest percentage. Bonds trade at a premium when priced above par and at a discount when below. Most importantly, remember the seesaw. Rates up means prices down, and rates down means prices up. And while the coupon rate stays fixed forever, the yield changes as the market price fluctuates. Master these concepts and you'll have a solid foundation for everything else in debt securities. Thanks for watching. If you found this helpful, you can sign up for the full course and 6 mock exams. There's a link in the video description. And if you want a discount, check the channel description.